A lot of investors put money into stocks and stock funds because they don't feel like there's anywhere else they can invest and have a shot at making decent returns. In this video, we'll challenge that notion and demonstrate another approach. With today's interest rate environment, it can be very easy to get frustrated with the classic choices for keeping your money safe. CDs and treasuries pay practically nothing, and even investment-grade corporate bonds are only paying a bit more than 2%. With such low rates, many investors feel like the stock market is the only place left to turn. They feel like they have to stomach the fluctuations and even brave the periodic downturns, because otherwise they would doom their savings to rates of return that are too low to meet their needs. In simplest terms, they do something they don't really want to do because they don't feel like they have a choice. But there is a choice. The group of investments that go under the heading of alternatives may not be as widespread as the more traditional choices. That's largely because the financial industry has trouble conducting a meaningful market in them due to limited supply or slight differences from one deal to the next. But just because the big boys have trouble distributing them, don't assume that means they're somehow inferior. In fact, every year large investment firms buy a significant portion of the alternative assets which come available. But instead of buying for resale, they buy them for the firm's own accounts. Investors looking for something that can beat the 1 or 2% rates on low-risk instruments, but who don't want to sign up for the fluctuation and downturn risks of an exchange-traded asset like stocks, owe it to themselves to explore what's available from the alternative space. And believe it or not, this idea is especially true for those who are in the market right now and have done well the past couple of years. That may seem counterintuitive, but it really isn't, since the more you succeeded, the more you stand to lose. Most families who get wealthy and stay that way understand this principle. It's common that they made the bulk of their money from a single business or activity, but they preserve it by moving it away from the original source into diversified holdings elsewhere. That way, the exposure from a single loss is greatly diminished. The same principle holds for those who have made money in stocks. Think about it like this. We all know that at times the market gives, but we also know that at other times it takes back. If you've just been on the receiving end of a give cycle, there's nothing that says you're obligated to hang around for the take cycle that often follows. It's not like the market is going to be offended if you leave, nor is it going to care if your previous gains evaporate. And having to go through a downturn may be a bigger deal than you realize. There's a popular notion that the best way to deal with a downturn is just to be patient and wait for it to recover with the passage of time. But that premise has two fundamental problems. First, while waiting, you aren't earning anything. Hedge fund guys and other pros refer to that as dead capital, because your savings are tied up, but they're not producing anything. So that's bad enough. But the second problem is even worse. If you have to have some of your money in the interim, when you take it out, the loss becomes permanent. Because even if the market goes back up later, you won't participate in the recovery. When you sell and take that capital out, you stop being an investor as far as those dollars are concerned. So even if the market eventually goes back up, it won't do you any good. The easy way to avoid both of those negatives is to get out before the market ever tanks. If long-term financial stability is a goal, an investor might consider a move away from stocks into a diversified portfolio of different assets, ones which don't have the same history of fluctuation, but can still earn substantially more than the traditional interest-bearing instruments. In fact, many investors that we talk to tell us that they have trouble envisioning a scenario which could be any better. So in a second, we'll look at a portfolio of non-traditional assets designed to do just that. But before we do, a couple of thoughts on selecting assets for a portfolio. The first thing to note is that it's really tough to know you've made a good selection if you don't already have a detailed sense of what you're trying to accomplish. It's beyond the scope of this sort of format to make a lengthy case for the value of thorough planning, but suffice it to say that without it, the process of selecting specific investments from among the available options is a lot harder. Second, sometimes we can tell immediately that a particular investment is clearly the best choice, but there's still the matter of ranking the remaining options as second best, third best, and so on. Doing so is important because no matter how good the first choice fits, you shouldn't put all of your money into it. Proper diversification is a must for having a truly robust portfolio, and obviously that goes out the window if you put too much of your capital into any one investment. So we do want to acquire some of the first choice. But then we need to go on down the list, investing in the runners-up until we have several. We usually like to see at least 4 or 5 asset class level allocations in most cases. With that in mind, let's look at one example of how an investor might create a diversified portfolio using nothing but alternative investments. Remember, our question at the beginning was whether or not it was possible to get out of stocks without settling on the return front. Have a look at this model portfolio and see what you think. Let me walk you through some of this. Down the left side, we've got our various asset classes and the percentage of overall portfolio we're allocating to them in this example. Next to that, you see some ranges for the rates of return. Actual investments are comprised of terms set by the specific issuer and may differ slightly from one offering in the same class. Here we've tried to give a sense of a reasonable range of expectations. Also, in order to do some calculations, we had to arbitrarily pick a particular return from within the range. Actual deals in these various asset classes could be higher or lower in a live setting based on what's available in the market at the time the investment is made. The final columns are the dollar amounts associated with each allocation and the contribution that each makes to the overall weighted average return, which, as you can see for this set of assumptions, models out at 6.7%. As a quick aside, we're assuming that this is a hands-off portfolio. That is, there's no real need for the investor to do anything or have any type of specialized involvement with any of the holdings. Even in the case of the rental property, we've assumed that the investor is going to hire a professional rental manager to handle the details and coordinate upkeep. The assumed rate that we use is net of those expenses. So like I said, this is assumed to be hands-off. Investors who do want to actively participate in management or deal making could potentially see even higher rates. Also, we're not going to delve into taxes here because what one investor pays could be very different from what another pays based on a whole host of factors. But the fact that multiple treatments for a given transaction might be available under the code raises the possibility that an investor who takes the time to maximize tax efficiency might see an additional bump in realized returns. And it's important not to lose sight of that. Okay, so this particular version of a non-traditional portfolio modeled out with an expected return of 6.7%. Testing that back against our goal of leaving stocks without settling for 1 or 2% shows that this should accomplish what we were after by a significant margin. In fact, even though we weren't necessarily trying to beat stock rates per se, take a look at how these results would have stacked up against the average returns that market investors have gotten over the past 15 years. These rates are close approximations which we calculated based on the change in index levels. We left out the dividends, but we also left out commissions and fund fees. Each of those components run 1 to 2% each year, and for most investors, they will more or less cancel each other out. Anyway, to get back to the main point, we met the goal and mapped out one version of a plan that could allow us to move beyond stocks without settling for low returns. In fact, we have results that look to be better than what we would have had if we'd stayed in the market to begin with. That's significant because the assets in our model portfolio are generally going to be lower in terms of their risk profile. In some instances, that's going to come from guarantee features made by the issuers. In others, it comes from the simple fact that the underlying assets themselves are generally not subject to the wild market swings that occasionally befall the stock market. So the values can remain more stable, and the likelihood of having to sell into a down market is reduced. Now, the notion of higher returns at a lower risk level might strike you as odd. It's generally assumed that risk and return move in opposite directions based on some orderly set of relationships. That's the theory. In practice, that relationship is a lot less well defined. In fact, when you're talking about assets which trade on exchanges, like stocks and commodities, there are often periods where all rhyme and reason go out the door and the link between risk and return becomes all but non-existent. The markets frequently earn a lot less than their volatility and risk would imply. So finding non-market assets which earn more at lower risk levels is in fact possible. And that's the case in this example. Bottom line, investors don't have to brave the stock market in order to have a shot at meaningful returns. They just have to be willing to look past the traditional offerings and consider investments that might be a bit less mainstream. Some folks unfortunately feel a strong desire to do what everyone else is doing, even if it isn't working out so well for them. Over the years, I haven't found that there was a whole lot that we could do for folks like that. On the other hand, I have found that when dealing with investors who are more interested in results than they are with blind adherence to tradition, we can often find multiple pathways for helping them get closer to their goals. If results matter to you, take some time to explore what's available outside the usual options of stocks, bonds, and CDs. You'll probably end up being very glad that you did.